Welcome to the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio Financial is proud to support the Thematic Investors podcast with host Kieran Cavanna. Unlock the potential of precise and dependable investment data with Vidrio Financial's data management solution. We shoulder the responsibility of your data, from its collection to extraction, transformation, and enrichment. With a track record of monitoring over 2,000 diverse funds and processing millions of data points each month, Vidrio leads the discussion on how investors can harness advanced AI and human expertise to maximize alpha performance and enhance their data accuracy. Discover how Vidrio empowers your data with comprehensive analytics on performance, cash flow, risk, and valuation, all delivered seamlessly through Vidrio's Data Management Hub. By consolidating multiple systems into a single source of truth, Vidrio saves your investment teams valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Welcome to the Thematic Investors podcast. I'm your host, Kieran Cavanna of Old Farm Partners. Our goal is to bring you great investors and the themes they're working on. Some are under the radar, and we think they're all experts in their discipline. Very happy to talk to John Ciampaglia today, the CEO of Sprott Asset Management. Sprott manages more than $30 billion, focused primarily on precious metals and critical materials. In their 2 decades in business, Sprott is the dominant firm focused on metals and mining space. And it's very timely with things going on all over the place, whether tariffs or metals and trade war. Welcome, John.
Yeah, thank you for having me. And I couldn't agree more in terms of timing. We obviously booked this many weeks in advance, and I never in a million years would have envisioned some of the things we're seeing in the markets play out.
Well, let's see what happens by the time we air this versus what we talk about. So there might be some resolutions. We'll see. But to kick off, it would be great. I'd love to hear more about Sprott. And you guys do a lot of different things, I know. So maybe you could do a short version of everything you do.
Yeah, sure. That would be great. Well, Sprott's been in business going all the way back to the early 1980s. The firm was founded by Eric Sprott, who is kind of a legendary investor and hedge fund manager for many years. He's no longer involved with the company. He's having, fun with his own family office these days. But, the legacy I think he left with us was one around metals and mining. And a lot of that has to do with where we're located. The company is based in Toronto, and it's considered the mining finance capital of the world. And so we're a small boutique money manager. We focus exclusively on all things metals and mining. We operate right up and down the whole capital structure, everything from getting involved with private mine finance transactions, whether they're loans, streams, royalties, investing in public equities, both actively, passively. And then the big part of our business is related to physical commodities, which we really love. It's a unique part of our business, and not a lot of people are really in the weeds with physical commodities like we are.
Yeah, I think people most know you for the latter, what you just mentioned, that the ETFs or the trusts. Is that right?
Yeah, our flagship products are investing in physical commodities, and there we cover gold, silver, platinum, palladium, uranium, and copper. So it's quite a gamut of physical metals. These are all in physical forms that we store in different vaults and warehouses. So it's really unique in terms of allowing investors to invest directly in physical markets when we can actually wrap them inside of an exchange listed vehicle like we have done.
Right. Well, and I was lucky enough to have met Eric Sprott 20 years ago. So I do know the roots of your firm, and it's really amazing what you guys have become. I would love to actually kick off also on you. You're CEO of the business, and just a little bit of background on yourself and how you got here.
Yeah, it's interesting because I was told by LinkedIn I hit my 15-year anniversary at Sprott last week. So it feels a lot longer than that, just given how incredibly busy my career has been and how it's evolved. But, I've been in the asset management business exclusively for a little over 30 years. I absolutely love it. It is a great business. There's so many smart people that work in our field, and it's so dynamic, ever changing. And I guess I'm just very naturally curious, intellectually curious. I love kind of learning about new things and reinventing myself. And the CEO job at Sprott, which I've been in for the last 8 years or so, has really allowed me to get involved in a lot of really interesting areas and commodities. But before my time at Sprott, I worked for one of the really large supermarket type investment managers called Invesco. And then before that, I started my career with TD Asset Management and as well as in the securities part of that business. So, the one thing about living in Toronto, it is also a huge financial services hub here. And I've been fortunate to work for a number of really great companies and learn along the way and really, fine tune my skills and involvement in a lot of different asset classes. So it's been a great journey. I'm obviously really happy with my results to date.
Well, it was interesting at a big group dinner I went to recently that you hosted. What was amazing is that you could field so many different questions and without saying, let me get back to you on that. So I was pretty impressed with your knowledge of the space.
It's funny because my wife watched an interview I did on CNBC and she said, "How do you remember all that stuff?" And I said, ADHD.
Yep.
It's good for something. So, but yeah, no, I'm a bit of a sponge with things, and I'm kind of a voracious reader of a lot of different topics. So I'm able to kind of cover a lot of different markets to some degree anyway.
Well, let's do that. You mentioned all the commodities you guys are in. We'll touch on each of them, but I think the big kahuna right now is gold. And obviously, we're in one of the biggest bull market moves for gold in our lifetimes. I would love to see maybe set the table on where we are with gold. Where's demand coming from? And is it retail? And why will it keep going, or why is there hype in it? I'd love to know what you think.
Yeah, well, I think you're right. I mean, the move we've seen in gold in the last 15 months or so is unprecedented. Going back to 2024, where it was up 27%, which was pretty close to where a lot of stock indices closed, was actually very abnormal. So that was kind of thing one. And then, into the first quarter and a bit of 2025, we're up about 30% already, which again, gold is not designed to do that. Gold is a long-term store of value, which has, proven its worth over millennia, not years or decades, but millennia. And historically, if you go back to its performance, 7, 8, 10% returns over 20, 25-year time horizons is pretty typical. So for it to go up 27 and then 30% is obviously flashing a really big signal. And obviously it's reacting to all the upheaval, all of the uncertainty, and basically this reordering of the global financial and trade system that is being attempted right now by the Trump administration. And gold is historically not just a long-term store of value, but has proven through multiple financial calamities and dislocations that it is a very effective safe haven asset. And one of the things that's playing out right now that's giving gold, I think, an added boost is historically in those dislocations, US Treasuries and the US dollar were also safe haven assets, like things like Swiss franc and yen have been. But in this current environment, it's not having the same effect. The US dollar is under selling pressure, US Treasuries, the yields have been going up against an environment of falling stock prices and whatnot. So it feels as though to us that gold has kind of got the whole lane here to itself in terms of being a safe haven asset. So the question is, the performance has been excellent. What about the flows? How are our investors responding? Well, the category that we follow are the gold ETFs globally, and they're about $375 billion. So, it's not a big amount when you compare it to, the market caps of some big cap tech stocks. And the year-to-date flows are 30 billion. And so against this backdrop of 30% returns when stocks are down, 20 to 25% on average, $30 billion of inflows globally is nice, but I would argue that investors are just starting to allocate to gold, and that previously investors were largely indifferent to gold and weren't paying attention. And the answer to why that is pretty simple. Everything else was kind of working just fine up until recently. And we like to think of gold as almost like an insurance policy. And so an insurance policy has a couple of variables. It's what's the probability of risk and what's my potential risk or loss of, risk of loss. And if you think about what's going on in the world, I think the probability of risk of a loss has gone up and the risk of loss have gone up. And so you're theoretically willing to pay a higher premium for that portfolio insurance. And I think that's why gold is performing very well. We've had some really large inflows into the Sprott Physical Gold Trust in the last 2 weeks. We're through $1 billion of net flows year to date, which is great. But I think we're just getting started in terms of investors starting to reallocate to gold after, many years of kind of ignoring it.
It's been interesting, right? The ding on gold always, in my experience, has been doesn't yield anything. Why wouldn't I buy treasuries? I get 4% or 3%, whatever, or today you get money market, you get 4%, but we've jumped that really because of what you're talking about, haven't we? That there's destabilization and it's sort of just a stabilizing asset. Without sounding like a commercial for what you guys are doing, how does a gold trust work? How does that actually physically work? Like, what is someone buying when they buy a gold trust?
Yeah, sure. So our gold trust is listed on the New York Stock Exchange since 2010. It's also listed on the Toronto Stock Exchange. It just crossed $12 billion in assets. And really how the fund works is pretty simple. It's a closed-end fund listed or domiciled in Canada. And I'm going to come back to why that's important for US investors in a moment. But it basically is a closed-end fund. And if the fund trades above its net asset value at any point during the trading day, we can issue new equity in the trust. We take the proceeds and buy more physical bars, which are 400-ounce London Good Delivery bars. And we procure all the gold ourselves at Sprott, and we basically have it all shipped to our vaults at the Royal Canadian Mint. So some of the differences between our gold trust and some of the other ones in the marketplace is, one, as I mentioned, it's domiciled in Canada, not in the United States. Why that's important? If you're a non-corporate US taxpayer, you can actually file an election in your tax return, Form 8621, and make a qualifying election and have the gain on your trust units treated as a capital gain. And the reason why I'm raising this is that all gold in the United States, whether it's a coin, a bar, or an ETF, is actually subject to collectibles tax, which is 33%. So there is a bit of an arbitrage there in terms of the tax treatment between all those forms of gold and our gold trust. And that's one of the reasons why it's been very popular amongst US high net worth investors. Second of all, we store all of our gold with the Royal Canadian Mint, which is a federal crown corporation of the government of Canada. And for many of our investors, they find it important to store their gold outside of the financial system or outside of the bullion banks who historically have stored most of the metal. The trust only holds fully allocated and segregated gold as well, which again, many people value. There's no unallocated gold. There's no paper forms of gold. It's just gold bars. And these attributes for some group of investors are disproportionately more important to them. So that's those are the reasons why it's different. So we are very actively raising capital in the trust. And one thing I forgot to mention is it actually has a physical redemption feature. So if you own enough units to tender them back to us monthly, we'll actually make arrangements and send you a 400-ounce gold bar. And you might say, well, who has enough units to actually exercise that option? Believe it or not, we do get requests from high net worth investors or family offices and say, you know what, I'd like to take my gold bars out of the trust, and we will facilitate that. And that's a very unique feature relative to the other gold ETFs where only authorized participants, which are market makers, are able to get their hands on the physical gold.
That's pretty
Big
cool.
difference.
I actually didn't really know how that worked. And, it's an interesting structure. And I know you apply it to other metals. So we'll get to that in a minute. But just real quick, I mean, obviously, I think, you're pro gold and you hope this move keeps going. But, I keep thinking from a macro perspective, like what would drive gold up here and really make it core? I mean, what really drives it? Is it uncertainty? And then we get certainty and then everyone ditches gold? I mean, because I go back to one of my favorite long short managers talked about how weaponizing the dollar under Biden for Ukraine really catalyzed other governments to pursue gold as a core holding in their central banks rather than US dollars. So it's just another factor. But what do you think from here? Obviously, you want everyone to own more gold, but what do you think could drive that?
Yeah, you raised a really interesting point, is that this move in gold really started 3 years ago. And it was the freezing of the Russian assets through the SWIFT system that really was the catalyst for a number of central banks, and China being at the top, saying, oh my gosh, somebody, Russians just lost 600 billion or whatever the number was of assets with probably a few keystrokes. And that really, I think, prompted them to think about their foreign exchange reserves and what portion of gold that should represent. And I know we focus enormously on China because China, the People's Bank of China, has been the largest buyer among central banks, but it's not just China. We've seen Turkey, India, Poland, Singapore, a number of central banks around the world signal that they're going to be owning more gold in their FX reserves. And I don't know what the trade-off there is, less dollars, perhaps, less euros, I don't know. But clearly the last 3 years, we've seen unprecedented buying by central banks. So they were really driving the first leg of the bull market. It's just been in the last 3 to 4 months that Western investors are joining in the party. And they've been big buyers of gold in the last few months. And the other group that's really emerging is Chinese retail investors. There's some Chinese listed ETFs, gold ETFs, and they have been growing like crazy in the last few months. And, this is really an interesting signal to us because most mainland Chinese investors like to own physical in their hands, very small little wafers and bars. And the fact that they're buying billions of dollars in these exchange listed gold ETFs signals to us that they're very concerned about the trade war and obviously currency devaluation, which is already starting to happen. And so you've got this new group of buyers really starting to press the gas on gold accumulation. The other things that are unfolding in China are also interesting. The government there recently made an announcement allowing insurance companies to be able to own gold for the first time. So it's kind of a new buying group that could emerge, as well as commercial banks in China have also been given more flexibility to own physical gold. And, we bring up China because it is a very large economy with a very high savings rate. And collectively, you have all groups of government and businesses and individuals there buying a lot of gold. And the other thing I would mention is that when the price of gold historically has been very strong, we've actually seen the reverse behavior in China, meaning Chinese investors stop buying gold when the price is too high. And they're doing the opposite right now. They're kind of chasing the price higher, which I find very interesting.
Yeah, it's super interesting. I didn't even think of that. But like you have a historically savings in homes, right, or in real estate. And I didn't even think about gold. Like everyone thinks about stocks. And I'm already hearing from some of the hedge funds I deal with about some interesting. We hear about like trade war and all the negative around the United States, but I've just been learning about what's going on in China, as well as wage growth in Vietnam all of a sudden. But can we switch to another part of this? Because I think the rare earths are part of this trade war. I don't even think people know what they are. I had to look up many of them on the periodic table and what they're used for. Maybe you could just set the table for rare earths, because I know you guys do stuff there too, but it's a little more arcane to people. But like, what are the main issues going on with rare earths?
Yeah, so rare earths are a collection, and there's somewhere around 16 of them or so. Most of the names I can't pronounce. And so, yes, they're very unfamiliar with most people. but they have very, very specific applications for certain technologies, everything from making permanent magnets, which you use in electric motors, you use in wind turbines, and there are a lot of defense applications, which I think is very topical. The interesting thing about these metals, as their name implies, is they're rare. And China controls about 60% of the world's supply. And China, in the past, when it's had disputes with other countries, has basically weaponized them. A number of years ago, they were in a spat with Japan, and they said to Japan, we're not exporting any rare earths to you, certain rare earths. And right now, they're basically following the same playbook where they're implementing export restrictions on a number of these critical materials. This is important because these are not easy to replace minerals. They have very set applications for these key technologies. And this is part of a bigger issue around reshoring and, kind of energy independence and domestic production. And it's not just rare earths. If you think about, things like solar panel production, China dominates it. Electric vehicle batteries, China dominates the processing. It's not always the mining of these materials. It's often the processing. And, look, when everybody was friends, everybody was happy to ship out all of the smelting and complicated chemical processes to produce these kinds of minerals and end products to China. Now that everybody's fighting, obviously, Department of Energy, Department of Defense, the federal government are very concerned about security of supply because, like with COVID, supply chain resilience is a key strategic, I think, objective for a lot of governments now. So that's something that we're monitoring. It's not the easiest theme to invest in. There are some publicly traded companies that are primarily focused on rare earths, but it's very hard to invest in companies outside of mainland China.
Right. And so, I mean, like I own in our fund, we own a company that mines uranium, but they also have vanadium. And I know that's one of them, but are there, of the 16, there's some that are rarer than others, right? I mean, that's what I've learned, is that there are some that we're just not going to be able to find in North America that are not replicable, but there are some that we can get to.
Yeah, I think there are mineral endowments around the world. There are plenty in Canada, the United States. And the fact is that for the greater part of the last 10 or 15 years, we've largely been indifferent about developing our own resources. We've been very happy in a very global trading model and framework to rely on China for the processing of many of these critical minerals. Some of these minerals, weren't really even used 5 years ago. So a lot of them are quite nascent. Some of these critical materials are also byproducts of like smelting processes. I mean, when was the last time we built a new smelting or refinery in North America? Nobody wants this stuff in their backyard. So we've largely outsourced it to places like China that, have been more than keen to develop capacity in many different parts of the economy that we just have ignored.
Yeah, actually, maybe we could switch to that because I want to get into some of these other metals like copper, but maybe we could talk about the trade war. I mean, I was struck at the dinner that you had when you were talking about actually aluminum smelters and that all this stuff, everything, the processing of these materials, it will take years, if not decades. Is that, maybe you could talk about that a little bit, because it sounds great to say, oh, we're going to take over, US is going to annex Greenland and we're going to have this, this whole, who knows? I mean, you don't have to go into that part, but even Ukraine, right? There was a whole trade deal around mineral rights in Ukraine, but actually building that stuff in North America will take a lot of money and time.
Yeah, a really good points to cover here. I'd start off by saying that 4 or 5 years ago, investors that we've talked to didn't care whatsoever about investing in metals and mining. I don't think they really realized how important the supply chains are and how many industries are highly dependent on a number of these critical materials. That's starting to change very quickly. I think 2022 was a real wake-up call for a lot of countries in terms of the energy crisis that Europe and Asia felt the brunt of. But I'm always very keen to kind of explain to people that these are capital intensive industries. They're also very highly regulated from an environmental permitting process, et cetera. And that our standards are obviously much higher than other parts of the world. So the time to discover, delineate new mines, get approvals, raise the capital, and actually build the mines, you're looking at close to 15 to 16 years on average. And, you can't really cut too many corners of that process. Yes, government reviews can be, I think, a little bit overkill. We've seen a number of uranium mines that are starting to slip into their third and fourth years to get an environmental permit to build a new project, let alone the construction time. And governments are finally starting to openly acknowledge that they've been too obstructive in terms of developing new resources, approving, everything from high voltage transmission lines, infrastructure pipelines. Canada in particular has been really, really brutal about this. And it's a key focal point in the election that we're having next week here. But it will take a long time. There's always resistance to building these things in one's backyard. And again, these are complex infrastructure projects and they take time. The Chinese are incredibly effective and efficient at building these infrastructure projects because we've outsourced so much of that work to them over the last couple of decades that they are so proficient at it. And we're just not. We just haven't built a lot of these things in decades. And that's a big challenge.
Yeah, we'll get to uranium because I know China's building a nuclear power plant, 8 a year, I think. And we built one a decade. And but those guys who built it in Georgia said that they learned a lot, right? It did go over budget, but they learned a lot. So hopefully we see a build here. We haven't really broken ground on a large scale nuclear power plant anywhere in the United States. Canada's announced a few potentials.
Yeah, no, it's a really good case study. Everybody, gets up in arms about our inability to build, complex infrastructure projects. We used to be incredibly effective at building these facilities in the 1970s and 1980s, and then we basically stopped and we lost all of our knowledge and our skilled workforces. And I think the building of a nuclear power station is a really good case study where China has perfected it now down to 6 years to build one start to finish. And when you look at what's happening in places like the United Kingdom, most recently in Georgia, the Vogtle 3 and 4 plants, you're at like 12 years. And that is really challenging in terms of your cost, your budget, your return on invested capital, investors' willingness to put money into those projects. Public utilities are very nervous about getting caught on the wrong side of those big spends. So we have not seen, since those projects were completed, any new announcements around large-scale reactors. What we have seen, which is positive, is a number of initiatives around smaller modular reactors, which again are designed to deal with some of the shortcomings of the bigger projects, bigger budget initiatives.
Well, we'll get into that in a minute. I'd love to go through copper a little bit because there's, as you were talking, I was reminded that during the Biden administration, they set up either a national monument around southwest part of the United States, which is where we have all our copper, and so it prohibited any mining. It was related to Native American land there, but I think we're all now coming to grips with the irony of embracing electrification for the sake of the environment, but then not allowing any copper mining. So which is critical. So copper just hit an all-time high in March. Maybe you could talk us through copper a little bit. That is a very big commodity.
Yes.
Big demand. What are you seeing?
Yeah, so it is a big market. It's a $200 billion a year market. And if you think about copper, change the way you think about it. It's not, pipes for plumbing anymore. It is all about electrification, electronics, data centers, clean technologies, to some degree, defense industries. The other thing I would say about copper is we've been mining it for 5,000 years and all the easy stuff's been found. And so if you look at ore grades, let's say 125 years ago would be typically 5% ore grades. So 5% of the ground is copper concentrate. Now you're talking about ore grades that are sub 1%. And the locations of those mines are either in the Andes at really high elevations, where it is very challenging to work, where there are shortages of water, obviously, because there's desert-like conditions at high altitude, or the big copper deposits are being found in places like the DRC, Congo, which, is unfortunately one of the poorest and most corrupt countries in the world. So where we're finding copper today is lower grade or in much more challenging environments to build mines or to sustain mines with unstable government regimes and whatnot. And I think the last couple of years has been a real eye-opener. If we want to increase our electrification, that copper is really the backbone. And for the last 20 odd years in the United States, there's been zero load growth, or very nominal, I should say, load growth, where maybe it's, half of a percent per year. And so we were very accustomed to maintaining largely the power output that we had, managing it through efficiencies and technologies. But, if you look at the estimates for load growth, and yes, it's kind of fluid, based on different assumptions for AI data centers, which are very electricity intensive, we're going to need a lot more copper. And the market right now, I would say, is balanced. But in the next 2 years, you're starting to see a copper deficit form. There's been a lot of disruption to different copper mines around the world in the last 2-3 years. Some of them are geological, some of them are political. And then the other, twist to copper is China processes about 50% of the copper for the globe. So it's not just an industrial metal, but it's also one that's very entangled in this trade war right now, potentially.
It's it's an amazing point. I actually learned that from our current Treasury Secretary in the United States, that China smartly dominates processing of so many metals, right? I mean, manganese, it's like 96% of manganese is processed. They don't even have manganese, or they have very little. So the processing, which is a dirty business, am I correct? That is something that they dominate over there. And so that's obviously something we're going to have to deal with.
Yeah, I mean, if you look at the supply chains for lithium, cobalt, graphite, manganese, copper, I mean, China will process anywhere from 50 to almost 100% of these things.
Right. One of the things with copper, I've fallen for the copper story. So I just would like to be the devil's advocate a little bit on where you see electrification, you see 5-year out projections, and you say, well, we're going to need more copper in the next 5 years than that's ever been mined. So things like that. But then it seems like it's hard, right? It's capitally intensive, takes a lot of money, a lot of manpower, a lot of things to go right, as you point out. I don't know how you guys, what you offer investors, but I found that buying miners, it really could be hit or miss. It really was very company specific.
Yeah, I mean, that's one of the challenges with these sectors, is that you can make the right macro call, but then the way you execute it could blow up on you. And that's because individual companies, mining companies, carry a lot of specific risk. And that could be geological, that could be some kind of a, issue at site, a social license issue, environmental permits. Resource nationalism is a growing concern. And what I mean by resource nationalism is you have an improvement in the price of these different metals, and all of a sudden cash-strapped governments say, hey, we want a bigger piece of the pie, please. Here's the new, mineral tax or royalty regime. Thank you very much. And so you don't get that operating leverage that you hope to get. I think with respect to copper, the best example I can share with you is the Cobre Panama mine that First Quantum, which is a Canadian mining company, owned and operated in Panama, that was closed a couple years by the government. And I was talking to an institutional investor, and he said, the challenging thing about investing in some of these themes is, you thought you were investing in one of the world's best copper miners, and what you ended up investing in was the Panamanian political system. And those are the kind of nasty surprises you want to avoid. And I think for that reason, ETFs with kind of a diversified approach to buying a group of companies is one way to mitigate against some of that company specific risk. And at Sprott, we offer a few funds in the copper mining space that do that.
Well, maybe we'll go back to uranium real quick, if you don't mind, because we have exposure, full disclosure, to uranium miners, and it's been a tough trade. And I would love to know what you think now, because I've read that you have a very, very bullish 2 to 4 year view. It's hard to have that kind of view when you have these mining companies that some of them don't have any revenue, but they have a great claim. But the struggle with uranium, we invested because of the supply side, the supply deficit that was building was our thinking. And then we got sort of surprised by the upside of demand, like emerging, 2030 and beyond demand. What do you think catalyzes this trade? You guys have your own product there, and actually we have a lot of overlap in some of our names.
Yeah, the uranium, we've obviously been, very focused and bullish on the uranium sector since 2021 when we launched our physical uranium trust. And it's been a huge success with the price of uranium going from the 20s per pound all the way up to $100 a pound briefly. But it's been very frustrating that we've corrected back down to 65. And I'm referencing the spot market here. And that's what this vehicle is designed to track. And so a lot of investors right now are saying exactly what you just referenced, which is we have today a structural supply deficit, which is only getting bigger over the next 4 years until new greenfield production is actually online, which is closer to 5 years from now. And so why isn't the price behaving better? And I think you have to kind of separate it into two buckets. The spot price is more investor driven and sentiment driven, and also reacts much quicker to market developments. The term market is the long-term market and the much larger of the two, where utilities buy uranium under these multi-year delivery timeframes. And that has actually been very resilient. The price went up 20% last year versus the spot price went down 20%. So we've got a real divergence. And so the question is, well, which signal is real here? Which signal should we be anchored on? And I think in the current environment, which is already very cloudy and uncertain, that investors have been focusing on the spot price signal, thinking, okay, something's wrong here. But the term market is telling you the opposite, that prices are elevated, producers are not reducing their offers in the marketplace, but we've had a stall in the contracting cycle because utilities first balked at the price being too high. Then they got rattled by Trump winning the presidency. How is he going to tinker with the Inflation Reduction Act, the Loan Programs Office? Obviously, the tariffs have been a big focal point and distraction. And then the last part has been, how is the relationship with Russia going to change, given there is a ban on importing Russian enriched uranium that's been in place since last August? Can that thaw that relationship and further, disrupt the current understanding that utilities are operating into? So a lot of uncertainty with all of those items. I think they've just pushed utilities to the sidelines. Now, in the last couple of weeks, what I'm hearing is that utilities are kind of starting to reemerge. They're saying, okay, tariffs were largely not applied to uranium because for good reason. The US produces very little domestically and requires a significant amount of uranium. And the numbers are pretty astonishing. The US requires about 48 million pounds of uranium every year to operate its fleet of 90 plus reactors that produce 19% of total electricity in the United States. And in the United States in 2025, the local production might hit 1 million pounds. So the US, again, here's a good case study of why would I tariff something that I'm absolutely forced to buy and don't have an alternative plan B? So it feels as though that tariff certainty is acting as a catalyst to get some of these utilities back to market. So I think that's positive. And the other thing I would reference, in the last few weeks, when a lot of industrial commodities have been under selling pressure, and obviously the energy complex, uranium price has been rock solid. It just hasn't budged. It's moved plus or minus $1 a pound over the last 3 weeks. So it seems to us like it's found a little bit of a floor. Now, the question is, what's the catalyst to kind of get it going again? And that's the part that everyone is kind of scratching their head around, but it will eventually come.
Well, maybe we're doing a good job on getting the word out with this podcast, because I'm aware of those numbers too. And it's extraordinary that, the US uses more uranium than anyone else. And the biggest producer of the world is in Kazakhstan. And we barely, less than 2% in the United States. So of our raw uranium, and then we ship what we have to Russia to be refined or to enriched. And so it is quite a setup that I feel like once it starts moving, it's going to move, don't you? Because it's just such a astonishing, in the world's biggest electricity market, and this is by far the best carbon-free baseload energy. I mean, I sound like a commercial myself, but it just makes so much sense to me. It just seems like it takes utilities a while to react. I know they have a lot of inventory, and so they don't need to go into the market right away. But at some point, they have to.
Yeah, it's just a matter of when, not if. The utilities are always well covered for their intermediate needs, and that's their goal, is never to be caught short fuel, because for two reasons. One, you don't want to turn off a multi-billion-dollar machine, but two, the time it takes to process raw uranium into enriched uranium to fabricated fuel bundles, that journey, which crosses many different countries around the world, can take about 2 years. So there's a long lead time to process fuel, and the whole nuclear fuel supply chain in the last 3 years has been heavily disrupted by Russia, as you mentioned, given Russia was the #1 enricher globally. And the US historically has always purchased 25% of its enriched uranium needs from Russia. Now, that is obviously shut down right now. There have been no deliveries from Russia over the last 6 months or so. And we don't know if there will be any more deliveries in the near term, because Putin has basically retaliated and said, I'm not sending you guys anymore.
Well, it's going to be cool to see. I know as you know, the Trump administration is super pro-nuclear. So Chris Wright, the energy secretary, has been all over this. So we'll see. They tweet about it a lot. I'd like to see some action, but so far so good. Maybe we could go back real quick to tariffs, John. I mean, because one of the things I think I've learned just from watching you and talking to you about these things is that the lead time is forever. And what Trump is trying to do is change the entire trajectory. And by the way, we have a bit of an electricity demand in the United States at the same time, where we're trying to put in data centers. And all of a sudden, after 20 years of flat growth, we're seeing big electricity demand. It really is hard. I mean, there's nothing easy about this. You know what I mean? Like it will take a lot of money and time. And I mean, how do you think like a positive outcome would be? Because it's not, we're not going to turn on 25 new nuclear power plants and have a bunch of aluminum smelters in rural United States. And, it's just not going to happen within 10 years. I mean, what would be a positive outcome from just your opinion on how tariffs are playing out?
Yeah, I mean, I think it's pretty complex. I guess the question is, are these tariffs designed to act as a negotiating lever to get, a better trade arrangement, or are they really designed to reshore some of these complex, industries that we've outsourced the last 30 years to, in many cases, emerging economies like China and other places? It's really hard to know. I mean, as I said, I think our biggest downfall is we just stopped building complex things. A lot of these plants and facilities, we didn't want them for a long time. Do we have the ability to build again? Absolutely. But, the biggest challenge I find is capital. Where's the capital coming from? This is a government, obviously, that doesn't really want to subsidize a lot of industries. They want business to stand on its own 2 feet. And so where's the investor capital coming from, given these are large-scale projects? They take many years to develop. Energy policy, which can help, seems to be changing constantly. If you think about, the Inflation Reduction Act, that was really designed to crowd in capital alongside government money. It's very uncertain as to whether we have the ability and the time to kind of engineer this reshoring that everyone has been talking about. And it's not just the Trump administration. The Biden administration for most of its tenure was talking about reshoring a lot of critical industries as well.
Let's say it's the latter. That the real intent is to have high-paying, jobs focused around manufacturing. It will just take time. Although I will tell you, like I was lucky enough to tour Tesla's factory in Austin. It's the most amazing thing I think I've seen in my life. And then actually, I'm not an Elon Musk fanboy, but they're building the biggest supercomputer in the world in Memphis, Tennessee, and they couldn't get their own electricity there. They bought gas turbines, to put behind it. So, I mean, I guess there are ways, right? I mean, we can do it. Maybe not centrally planned like we did in World War II, but maybe we can do it just through the entrepreneurial process that exists.
Yeah, absolutely. I mean, obviously, tremendous wealth and innovation has occurred in many of these Western markets over the years, and the U.S. really stands out. So you just need to get the entrepreneurs, the risk capital that's committed to these projects, and I think some stability around it, policy, because people don't want to get whipsawed around changing policy and regimes that could have a disproportionate impact on the economics or, the timelines to bring a project to market.
Right. I mean, and I guess we're not going to see people lining up to put an aluminum smelter, money maybe flowing in for that, but maybe around nuclear and things like that, or maybe. Certainly we're seeing it in the utility space.
Yeah, I think utilities, I mean, I kind of joked last year that they're the new growth stocks. If you think about utilities being pretty boring, conservatively managed businesses that have, changed their mix of electricity assets over the years, but are largely, the same in terms of overall output. And all of a sudden, all of their customers knocking on their door saying, we want more electricity. It must have been a real shock for them saying, how are we going to rise to this challenge? And I think that's one of the reasons why, the hyperscalers, the Googles and Metas and whatnot of the world kind of took matters in their own hands and said, like Tesla, we're going to solve our own problem, whether it's electricity or power lines or whatever. They're going to solve their own issue. And I think while there's a little bit of air coming out of the whole AI story and some of the CapEx budgets maybe were a little bit too lofty, I still think there is a push afoot to increase load growth in the U.S. grid for sure.
Well, I know you guys do some private strategies too. I'd love to know, are you seeing capital line up for that, or is that much harder?
Yeah, that's a very interesting part of our business at Sprott, where we basically do what we refer to as mine finance. And what that means is if a company is trying to build, let's say, a new mine or expand an existing one, they can't go to the bank and say, hey, lend me several $100 million, please. The banks don't want to be involved in those projects. They're just too risky. They require way too much technical diligence, mining engineers, geologists, but we have a team of those people. We'll evaluate those projects and say, you know what? We'll give you $200 million to build the mine. Here are the terms, which is basically a debt instrument. We usually get equity kind of sweeteners or warrants. And as they de-risk the project by building the mine, what will happen is a bank will come along and say, okay, we're willing now to financially support you. We'll basically refinance your loan with Sprott at a much lower interest rate. We get paid back our capital, and our investors are happy bridging them for, typically 2, 3, 4 years while they de-risk the project, and they can get a lower cost of capital from a bank. And these loans that we've been doing at Sprott for about 20 years, I think it's fair to say we have a very strong track record in terms of making high quality loans. Most of the investors in those limited partnerships tend to be large state pension plans, endowments, those kinds of things. They're looking for much higher rates of return, not quite private equity, but very high yield oriented debt that is highly secured.
Yeah, but my question is around that. It's great to say that basically every commodity you guys are in is demand's high. Are you seeing more demand for these longer lasting illiquid structures, or is it the same as it's been?
Yeah, I mean, I think it's fair to say that each of our vintages has gotten bigger. And so there is interest for sure, particularly when we're in a very compressed interest rate environment. When we were at zero interest rates, essentially, people were looking for alternative sources of yield. And that's really where these vehicles have done well. The other thing that I think is unique is that because we're senior secured in the capital structure and the capital stack, you can have a mining company, struggle and their equity could perform very poorly, but you do really well in the loan. So
Right.
they tend to be a very different risk return dynamics versus investing in the equity.
Well, you guys are where you're at A1A right now in terms of investor interest. So, I mean, you're at 30 billion plus right now. Where were you guys 3 years ago?
Oh, that's a great question. I don't know the number
Ru-
off the top of my head, but probably 20,
Okay, so
something
not
like
that too
that.
good. I was wondering if it was like 3x or 4x, but I always think you guys are thought leaders as well. So I love reading what you guys put out. So it's super interesting, and we should stay in touch on all these things. And really appreciate your time. I bet people learned a lot.
Yeah, thank you for having me. It was a great chat.
John, thank you.
Thank you for supporting the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio's data management solution collects, scrubs, and allows investment teams to filter out the data noise, providing you with actionable data intelligence for further visualization around valuation, risk, and portfolio management. If you are an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office struggling with your data pipelines, then reach out today and see how Vidrio's data management solution can help by becoming an extension of your investment team. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial and/or our host, Kieran Cavanna. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.